about different models of microfinance. And the most famous model is the model of Grameen Bank. The most striking feature of distinctive feature of Grameen Bank model is that a group of five women borrower is normally formed, and a field manager, contacts them and keeps liaising with them. So a bank unit is set up with a field manager and a number of bank workers covering an area of about 15 to 22 villages. Field manager visits the village, familiarizes with the local milieu, explains the purpose and model of mode of operation of the bank. Initially, a group of five prospective borrowers is formed who meet regularly with Grameen Bank field managers. Typically, two of the five prospective borrowers are granted loans. So if these two initial borrowers make payment on time, then only third and fourth and fifth member of the group is eligible for borrowing. So in this model, the peer pressure acts as a replacement for traditional loan collateral. And there is no requirement of collateral, but peer pressure and the group pressure basically acts as a security, as a safety cushion. No legal instrument. This all arrangement is informal because legal documents are not signed between the borrower and lender. This system works on the basis of trust. And this trust-based model has worked for Grameen Bank, and their recovery rate is 98%. 98% recovery rate means only 2% borrowers are not able to make repayment. Rest 98% borrowers are actually making payment on time. So this is a success story of Grameen Bank. And the interest rate that is charged by Grameen Bank is around 20%. 20% is the average interest rate charged by them. The main the interest rate charged by them on their main product is 20%. Although it might be looking higher. I mean, 20% is a higher rate of interest because industrial loan or business loan is available at 13%, 12% also. In comparison to that rate of interest, 20% is higher. But the cost of administering microfinance loan, a small loan, is a lot higher. So this interest rate has to be higher to justify, the additional costs involved in microfinance business. Then the second model is called Village Bank model, and this model was promoted by Finca. Finca International. The name of the founder is John Hatch. It was initiated in 1984. So this model is developed in Western world. So it may not be very fit in the developing nations like India. But nevertheless, it is successful in developed nations. So Finca is the innovator of the village bank methodology in microcredit and is widely regarded as one of the pioneers of modern day microfinance. Finca International is a non-profit microfinance organization founded by John Hatch in 1984. A village bank is an informal self-help group of 20-30 members, typically female members of the household. So what happens in this model is that 20 to 30 members, female heads of households are formed, and you may call it self-help group also, self-help group of SHG of females. And this group is an informal group. I mean, they don't have any separate legal identity, no separate organization or NGO or company is registered. This 20 to 30 member group is an informal group. So members meet at one of the members' house weekly for working capital requirement, motivation, saving, skill training. Loans normally start at $50 to $100 and are linked to savings such that the more a client saves, the more she can borrow. And this member of 20 to 30 member are self-governed. Self-governed I mean, they conduct their own meeting, they make their own laws, rules, um, and the funding comes from outside. The funding comes either directly through, either directly or through an NGO. So the normal loan period is 4 months and is repaid in 16 weekly installments. 95% clients are female. It relies on a system of cross guarantee. So those 20 to 30 members actually give guarantee for each other. So if a member borrows, then the rest of the members act as guarantors. So when each member of a village bank ensures the loan of every other member. So in this case also, the system of peer pressure and social pressure actually works. So this system gives rise to an atmosphere of social pressure within the village bank, where the cost of social embarrassment motivates bank members to repay their loans in full. This method has proven very effective for Finca, yielding a repayment rate of over 97% in its worldwide network. So the repayment rate of Finca is around 97% in its overall worldwide network in different countries. Village banks are highly democratic, self-managed. So these 20 to 30 member household, women household heads actually are self-managed and grassroots organization. They elect their own leaders, select their own members, create their own bylaws, do their own bookkeeping. They also manage the bookkeeping or accounting, manage all funds, disperse, deposit all funds, resolve loan delinquency problems, and levy their own fines on members who come late, miss meetings, or fall behind in their payments. Village banks depend on their financing capital on. So this is the second point, is the most important, that as far as financing is concerned, the supply of capital is concerned. So they depend on microfinance institution. So microfinance institution is a registered entity, is a company, it is an NGO, or it may be any other cooperative. It may be a cooperative on MFIs, either directly or through local NGO. So capital, if supplied by the microfinance institution on timely payment of installments, guaranteed jointly by the members of the village bank. So joint liability. So if a member is borrowing, so all those 20 to 30 member group is responsible for the repayment. And for this purpose, they make their own rules also, that what fines they are going to impose on a person who is going to default. Average portfolio yield of 71 microfinance institutions engaged in village banking was 27.7% in 2006, lower than local money lenders. So the rate of interest charged by this model in village bank model was 27.7%. It should be noted that 27, what is charged by local money lenders. Local money lenders means, traditionally what happens is that when a person is in an emergency situation, because of marriage, or because of some diseases, health reasons, so it approaches the local money lender. So the local money lender charges a lot of maybe 10% per month, 10% per month, which translates to 120% roughly, or it will be more than that, because of the concept of compounding. So in some cases the interest is charged weekly, on a weekly basis. In that case also, imagine the high rate of interest charged by the local money lenders. So in comparison to local money lenders, this 27.7% is lower. Otherwise, if we compare it with the business loan rate that is charged by the commercial banks, it is higher, 27.7%, a lot higher. But if we compare it with the rates that is charged by money lenders, local money lenders, then it is lower. The third model of microfinance is credit union model, which has evolved, especially in India. In India, this model is practiced in India. The most famous example of credit union is Seva Bank, in Seva Bank in Ahmedabad. Seva Bank. Seva Bank, the most notable feature of Seva Bank is that it is 100% managed by women. Seva Bank, Ahmedabad-based bank or cooperative society. So this model is known as credit union model. So credit union is a non-profit financial cooperative owned and controlled by its members. Credit union means every member is actually shareholder. So whenever a member becomes a member of credit union, basically he contributes in the capital of that company or that cooperative society. So this is called cooperative society. There are various acts in different states of India, as well as there is a central act also for multi-state cooperative society. So cooperative model is also one of the model, and this is more suitable in India because a lot of microfinance institutions are working under this model. And just I have given you example of Seva Bank. So in a cooperative society, what happens whenever a member becomes a member? So becoming a member means he contributes in the capital of that credit union or that cooperative society. So he becomes shareholder also. And another example that I can give you is very famous. I mean, from the Islamic finance perspective, is okay, I'm not actually able to Google that name. Okay, Sahulat Microfinance. Sahulat Microfinance is based in Okhla, New Delhi, and Sahulat. And they have a network of microfinance institutions all over India, including Lucknow, maybe Patna, and there are some branches in the South India also. And they help in the establishment of microfinance institutions. Even apart from one of the microfinance institution that is associated with Sahulat Microfinance is Al Khair Cooperative Society. Al Khair. So whether it is Al Khair or Sahulat, all of them are actually practicing this credit union model or cooperative society model. So credit union mobilize savings, provide loans for provident purpose. The benefit of credit union is that funds are generated internally because members open their account, saving account in a credit union bank. So funds are generated internally, and those funds are then lent out to the needy, to the borrowers. What happens in the other two cases is that funds are not generated internally. There is external financing. Some finance institution will bring out some capital and it will lend that money to the borrowers. But the benefit, the one distinctive feature of credit union is that savings are mobilized and that generates the capital that can be lent to the borrowers. So the capital is generated internally. So mobilized savings provide loans for productive and provident purposes, have memberships which are generally based on some common bond working for the same employer, working for the same employer, belonging to the same church, labor union, social fraternity. So there must be some common grounds on the basis of which all customers may relate to each other. Maybe all of them are small workers, maybe all of them are farmers, or maybe all of them are belong to some particular profession, particular industry. So there's some common feature binds them together, and they come and they form a credit union to help each other. Or living in the same community, a credit union's membership is open to all belong to the group, regardless of the race, religion, color, creed. Credit unions are quite popular in Asia, notably in Sri Lanka. Credit union is a democratic, not-for-profit financial cooperative. Each is owned and governed by its members, with members having a vote in the election of directors and committee representatives. Another that is in India, that is again developed in India, is called self-help group. Self-help group credit union is a formal model. Formal means it is the cooperative society is registered, but self-help group may be registered or may not be registered. Normally, I mean it's an informal model. For a fourth model originating in India is based on self-help group. Each self-help group is formed with about 10 members who are relatively homogeneous in terms of income. A self-help group essentially pools together its members' savings and uses it for lending. Self-help groups also seek external funding to supplement internal resources. So as I have mentioned that cooperative society is a formal group, formal or arrangement, legal arrangement, but self-help group is not a formal group. It is not it may not be a registered entity. So that is why it approaches for external funding also. That it needs some external financer to carry out their operation of microfinance loans, microfinance credits. Most of the microfinance institutions, I mean, though are doing it as a business, they lend money to self-help groups. So instead of, I mean, they are always in search of such self-help groups, and if they find, they may impanel them on their, they may connect with those self-help groups for the purpose of lending, because in that case, concept of joint liability, the concept of social pressure, the concept of cross guarantee can be applied. So the terms and conditions of loans differ among self-help groups depending on the democratic decisions of the members. Typical self-help groups are promoted and supported by NGOs, but the objective, as with Village Bank, is for them to become self-sustaining institutions. Some NGOs act as financial intermediaries for self-help group. So as I mentioned, self-help groups may not have their own accounts in the banks. So some other NGOs act as financial intermediaries for them, while others act solely as social intermediaries, seeking to facilitate linkages of self-help group with either licensed financial institutions or other funding agencies. So some funding agencies, they need, some financial intermediaries to extend the capital to the self group. So there has to be some linkage between self-help group and the funding agency. And sometimes NGOs act as intermediaries, financial intermediaries, and sometimes only as social intermediaries, but sometimes as both social and financial intermediaries. The self-help group model is a good platform for combining microfinance with the other development activities. So self-help group is not only for microcredit. Some other activities, for example, training, for example, education, for example, insurance, for example, maybe legal education, legal awareness, or it may be anything which is good for the society. All those activities can be performed using that self-help group model, apart from microfinance. Self-help groups are formed and supported usually by NGOs or increasingly by government agencies, and sometimes directly by banks. Self-help groups are linked to banks first with a group deposit account. account, and for credit which is dispersed to the group and in turn distributed to the member. So if the bank is linked to a self-help group, so normally a group deposit account is opened on behalf of all the members of that self-help group, and the loan is distributed to the members. There is a process of group formation and group leaders and members are trained on managing the saving and credit. Sometimes the training is also provided by the banks or by the microfinance institution that is extending a helping hand to that self-help group. Self-help group also have grown rapidly since 2000 across India, first in the more developed South, in North India too. The self-help bank linkage program is the flagship microfinance program of the NABARD, National Bank for Agriculture and Rural Development. This model, self-help group model, has been promoted especially by NABARD, which has been tasked by the government for the rural development and agricultural development, which has actively supported the development for this program since the early 1990s. Drawbacks: in the case of self-help group, there is little information even on financials. So as I have said that self-help groups are financial information transparency is slightly difficult. This poses this question on the sustainability and effectiveness on both financial and social aspects unanswered. Okay, credit union and cooperative society, both are related. I mean, the scope of cooperative society is broader than the scope of credit union. This cooperative society model, a cooperative is an independent association of people who come together voluntarily to meet their mutual economic, social, cultural aspirations and needs through a jointly owned and democratically controlled enterprise. Some cooperatives also include saving activities and members financing as well. Cooperative was first registered in India in the first decade of 20th century to provide loans for agricultural sector. Rural development, Indonesia and Sudan have been promoting this model. Examples from India: Sahulat Cooperative Society, Al Khair Cooperative Society, both into Islamic Microfinance. So in India, those who are practicing Islamic Microfinance have adopted this cooperative society model. So if I have mentioned it in under this credit union model, then just keep it this note that it is different. Credit union model is slightly different than the model of cooperative society. Cooperative society act is different and credit union bank is different. And we can differentiate between self-help group and cooperatives on these parameters. Self-help groups are normally located in rural area. Cooperatives are normally located in urban area. Self-help group is an informal group. It is not registered, but cooperative society is a formal group. It is registered. There are acts, and those organizations have to follow the guidelines provided in those cooperative societies acts. Self-help group is small and cooperative societies are normally very large because each member has to become a member. So whenever a person opens an account, he becomes a member of that cooperative society. Some shares are allotted to that member. In self-help group, the source of fund is external. The self-help groups depend, as far as their financing is concerned, they depend on external sources. Self-help groups depend for their financing on external sources. But cooperatives generate their own funds because members open a saving account and the money is pooled and generated, the capital is generated internally. So cooperative societies don't depend for their financing on some external sources. This is the striking feature of cooperative societies, that funds are generated internally. Islamic microfinance originated from experiment of Mint. So Mint Ghamr is the first Islamic microfinance institution, Mint Ghamr, which was experimented in Egypt. So Mint Ghamr was essentially a cooperative designed to serve rural farmers. So again, this was the target of this bank was, the target of this product was farmers and traders with Sharia compliant financial products, non-interest that are suitable to the local community. Hence, it is also claimed as the first experiment of Islamic bank. So Myth Ghamr is also touted as the first experiment of Islamic bank. Myth Ghamr was established by an economist, Ahmad al-Najjar, who upon returning from his graduate study in Germany wanted to provide the poor in his hometown with access to financial services. In its short span from 1963 to 1967, so it did not survive for long. It continued only for 4 years. Myth Ghamr was able to demonstrate that non-interest banking was possible. But one thing that this experiment proved, that non-interest based microfinance is possible. It is, I mean, a lot of people doubted that whether non-interest based can be practiced or not. But this experiment, that is the experiment conducted by Ahmad al-Najjar by establishing Myth Ghamr, he proved that it is possible to run non-interest banking, non-interest based microfinance is possible. So Myth Ghamr, the target was rural, the structure was rural bank. The country was Egypt, and it was established in 1963. Another Islamic microfinance institution was established in Sudan. The name of the bank is Agriculture Bank of Sudan, and the structure was bank. The country is Sudan in 1975. Then in Indonesia, Baitul Mal wal Tamwil, BMT, Baitul Mal wal Tamwil. This is a cooperative society. It was established in 1984 in Indonesia. Then the third Islamic microfinance institution that was established in 1987 in Malaysia. The structure was non-banking financial institution, NBFI, non-banking financial institution. The name of this NBFI is Amana Ikhtiyar Malaysia. So Amana Ikhtiyar Malaysia is in Malaysia, and Baitul Mal wal Tamwil in Indonesia. In our neighboring country, Pakistan, we have one Islamic microfinance institution by the name of Akhuwat. So Akhuwat, the structure of Akhuwat is NGO. It is formed as an NGO. It was established in 2001. So these five are the prominent top Islamic microfinance institution. If we are talking about Islamic microfinance institution, then these are the oldest one. But out of these five, one is non-operational. Myth Ghamr is non-operational now. The rest of them are working. Agriculture Bank of Sudan, Baitul Mal wal Tamwil, then Amana Ikhtiyar Malaysia, then Akhuwat. And then some of the microfinance institutions have evolved in India also. Al Khair Cooperative Society and Sahulat Microfinance institutions are example of that. What is the difference between Islamic and conventional microfinance? Islamic and conventional microfinance institutions can be differentiated from each other on several bases, including the source of funds, mode of financing, outreach, fund transfer, etc. So, starting with the source of funds. So, in Islamic microfinance, the source of fund can be external also and internal also. So if members are opening an account in that institution, so that will be called internal source of fund. So savings of the clients. Commercial bank, if the Islamic microfinance institution is borrowing from a commercial bank, and maybe from Islamic charitable sources, zakat and waqf. So zakat money is also a source of fund for Islamic microfinance institution. Similarly, waqf, there is a concept of waqf, that property and money can be devoted for for some special purpose, that is called waqf. And so waqf model is there, then zakat model is there, 2.5%. Every Muslim is supposed to make a payment of 2.5% of his wealth, not income, but wealth. Whatever is the wealth, he has to take out 2.5% every year from his wealth. That is called zakat. An institution can be formed around this concept, that is zakat model also, or even an existing Islamic microfinance institution can institute programs associated with zakat, that that zakat money can also be channeled for the purpose of Islamic microfinance products. And similarly, waqf is also a source. So these two sources, that is zakat and waqf, are called Islamic charitable sources. Apart from these two sources, other sources are also possible. But as far as conventional microfinance is concerned, they depend for their funding on external sources, and in some cases on savings also, and in some cases commercial banks also. But the thing that differentiates an Islamic microfinance institution is that Islamic charitable sources are an addition uh, over the conventional sources of finance. The second, on the second basis, the second basis of differentiation is mode of financing. So mode of financing in Islamic microfinance institution is Islamic financial instruments, Sharia compliant instruments, whereas in conventional microfinance institution, the products are designed on the basis of interest. The third basis of differentiation is outreach. Uh, in Islamic microfinance model, the poorest can be included by integrating zakat with microfinancing. So if we are able to channel the zakat money, then poorest of the poor section of the society can be addressed. So the products can target the poorest section of the society, because zakat money, even if there is delinquency, even if there is default, the zakat, money can be used in that case. But conventional microfinance, in conventional microfinance, poorest are discretionally left out. So studies have found that the conventional microfinance generally lends money to the already well-off people, and poorest section of the society is normally left out of conventional microfinance institution products. So non-inclusive system in place. So the system is non-inclusive. So those who are already well off, they take benefit from MFIs, microfinance institutions, and those who really need that product, those who really need credit, are actually left out. The fourth point is fund transfer. So in Islamic financing, normally instead of transferring money, goods are transferred. So say for example, if a small borrower needs a cart for selling vegetables, or for needs some machinery for manufacturing maybe candles. So instead of giving money to that borrower, in Islamic structure, normally the goods are transferred. The goods are transferred. So the Islamic microfinance institution purchases that cart and then gives that cart to the borrower, or purchases that machinery for the production of candle making and gives that machinery to that borrower. But in conventional microfinance institution, funds are transferred, cash is transferred instead of transferring the goods. Um, the cash itself is transferred. So this is also one point of differentiation between Islamic microfinance and conventional microfinance. The fifth point on the basis of which a difference can be made out is deduction at inception of the contract. So in Islamic microfinance, no deductions are made at the inception, but in conventional, deduction is made in the beginning itself. So if, for example, if 10,000 is being lent out in conventional microfinance institution, then only 950 rupees will be given to the borrower, and 50 rupees will be but he has to make repayment of 1,000 rupee. So the borrower, so initial cut is introduced at the inception of the contract itself, but this is not done in the Islamic structure, where no deduction is made at the inception. The target group of Islamic microfinance is family, and the target group of conventional microfinance is mostly women. So they target women, and they also say that women empowerment is their objective. So conventional microfinance, they highlight this aspect of microfinance, that we target women, and as a result women empowerment is happening. Objective of targeting women. In Islamic microfinance, also women are targeted. Normally, the loans are dispersed to the women only, but the purpose is the purpose. Maybe they don't highlight women empowerment aspect, but in Islamic structure, they say that it is because of ease, because they are available, and it is easy to deal with women as compared to dealing with male. Then the eighth point is liability of the loan recipient and spouse. So the liability in Islamic structure is normally the family. So the recipient, if and as well as the spouse of the recipient, both are liable for the repayment of that loan. In conventional bank, only the recipient uh, is liable if they are not following the joint liability concept. But if they are following joint liability concept, then the liability is shifted to the guarantor, also to the group members also. But normal, if they are not following these, okay. So those who are working in Islamic financial institution, their incentive is monetary also, and their incentive is religious also, because they feel a sense that they are doing some duty, religious duty, because helping the poorest section of the society is one of the noblest act in every religion. So those who do this task, that is the task of giving and helping the poorest section of the society by extending funds to them in their needs. So they feel religious motivation also. But in conventional bank, the conventional microfinance institution, their purpose is to make money, and that is why they practice a lot of one of the criticism of conventional microfinance institution is that they charge a lot of interest rate, and charging high rate of interest from the poorest section of the society is not ethical. So but their purpose, they have to be self-sustaining, so they go for monetary purpose, so their incentive is monetary only. But in case of Islamic microfinance institution, one of their incentive is religious also. How they deal with the default? If a member does not make payment, then what is done in conventional Islam microfinance? In conventional microfinance, group pressure or peer pressure is applied. In Islamic microfinance section, group pressure is also applied. Uh, Spouse guarantee is also applied. Then some Islamic ethics is also applied for loan repayment. I was just, the RBI, somebody sent me, the RBI report. In RBI report, they have quoted some hadith as far as the repayment of loan is concerned, just to motivate the the borrowers to make payment on time. So there are, sayings of the Prophet regarding this. So they have quoted those hadiths in RBI bulletin for this purpose. So Islamic ethics is also used as far as Islamic microfinance institutions are concerned. The last point is social development programs. Social development program. So religious includes behavioral ethics. So the training, social training, ethics and behavioral training can also be provided using these Islamic microfinance institutions. In conventional microfinance, secular behavior, ethical, social development. So this table has been taken from a paper. The author of that paper is Ahmad, 2002. So he has differentiated Islamic microfinance institution from conventional microfinance institution on these points. But the main thing that on the basis of which Islamic microfinance institution and conventional microfinance institution are differentiated is the presence of interest. Islamic microfinance can be defined as provision of microfinancial products and services based on Islamic principles. The main characteristic of Islamic microfinance is the absence of riba or usury, then gharar. Gharar is ambiguity in transaction. There should not be any ambiguity in the transactions. All things, terms and conditions should be clear. Product should be clear, the risk should be clear, whatever is there, all terms and conditions should be defined. So this concept is known as gharar. So there should not be any gharar in that transaction. And the third point is maisir. Maisir is gambling. The element of gambling should also be absent in that transaction. So these are the three basic prohibitions as far as financial transactions are concerned. In Islamic fiqh, these three things have to be eliminated from any transaction to make a transaction Sharia compliant, to make a transaction lawful. And the use of different financing contracts, unlike conventional system that relies heavily on interest and charge on credit on loans. There are three types of contracts available for Islamic microfinance, namely equity-based, trade financing based, microcredit, and charity based. So in Islamic microfinance, there are three models available. The first one is called micro equity. The second one is called trade finance based or microcredit, and charity based. So if the lender is giving money to the borrower and becoming partial owner of that business, that type of arrangement is called micro equity, because the Islamic microfinance is becoming a member, an owner or partial owner in the business of the borrower. So that structure is called micro equity. But if the microfinance institution, Islamic microfinance institution, is lending money to the borrower on the basis of qarze hasana or on the basis of murabaha, in that case, that structure is called microcredit, because Islamic microfinance is extending loan, interest-free loan to the borrower, or maybe on the basis of murabaha, but it's on the basis of this is a credit. This is a credit that the lender is giving to the borrower. So this is another structure. And the third structure is charity based. So charity based model is also there, a micro equity based model and trade based model, microcredit. We will talk about, we will now go for specific examples of micro equity and microcredit and charity based. Of these models or contractual arrangement, the partnership contract of Musharaka. Musharaka is seen as the most suitable for Islamic microfinance. Musharaka means partnership. Sorry. So Musharaka is seen as the most suitable for Islamic microfinance institutions. Musharaka means partnership. Partnership where the lender actually becomes partner in the business of the borrower. And some profit, the profit has to be distributed between the lender and borrower in a certain pre-specified ratio. So in Musharaka, both Islamic microfinance institutions and its borrowers are partners in a business. And this thing is, I mean, very similar to the venture capital, because in venture capital, the money involved is very large. But in case of Islamic microfinance institution, the money involved is very small, very tiny. But the structure is the structure of partnership, that Islamic microfinance institutions lends money to the borrower, becomes partial owner of that business. Where sharing of equity, one can contribute goodwill, cash, or other form of asset. So not only cash, but sometimes the other partner can also contribute any asset. The asset can be, any machinery or any vehicle or whatever is required for conducting that kind of business. So that partner can supply that asset. Profit and loss is agreed upon. Profit loss sharing is agreed upon at the beginning of the contract. And it's not that the profit and loss has to be exactly in the exact ratio in which they have contributed the capital. The profit and loss sharing can be different. So 100%, for example, 10% can be contributed by the borrower in that business, and rest 90% can be contributed by the IMFI. But as far as profit is concerned, profit can be shared in 60-40 ratio, or maybe 70-30, or 75-25. So it is not that, I mean, in whatever ratio the capital has been contributed, the profit has to be contributed in the same ratio also. It's not necessary. The profit loss sharing can be agreed upon by, among them, which can be different from their capital contribution ratio. However, in practice, most of the Islamic microfinance institutions predominantly use Qarz-e Hasan and commercial mode of Murabaha. But if we talk about what Islamic microfinance institutions are actually doing, so they are not much into Islamic equity. Islamic equity, that is Musharaka. Musharaka based model is not being followed by them. So then what is being followed by them? They are mostly following Murabaha model. Murabaha is cost plus financing. Cost plus financing means they purchase that goods and they sell that goods to the borrower at a cost plus basis. So for example, if some machinery is required by the borrower, so the Islamic microfinance institution borrows that, purchases that machinery from the market, say for example at 10,000 rupee, and gives and sells that machinery to the borrower at a price of 1,050 rupees. If it has borrowed at 10,000, then 10,500 rupees maybe. So that 500 is actually the profit of that Islamic microfinance institution. Now let me make it very clear that when we say interest free does not mean interest free. Interest free is not equal to cost free. Interest free is not equal to cost free. So interest free does not mean that the financial institution, Islamic microfinancial institution, cannot charge any cost. There will be some cost of administrating that loan, and that much can be charged by the Islamic financial institution. Similarly, on cost plus basis, a sale transaction is also valid. So what differentiates between interest free and what differentiates interest free and interest free financing from interest based financing? The difference is the compounding. Compounding means whatever, in Islamic financial institution, if the goods has been sold at 10,500 rupee, the borrower has to make only a repayment of only 10,500. The liability will not increase if he defaults. If he does not make payment on time, the liability will not increase. But in conventional microfinance institutions, if he does not make payment, then his liability will keep increasing. The liability will keep increasing because of the concept of interest, because interest keeps increasing and increasing. The more time will pass, the more money will become, the amount of liability will keep increasing, which is not a feature of Islamic microfinance. In Islamic microfinance, interest is not there. So, of course, there is cost because for example, in Murabaha, the Islamic microfinance institution is purchasing some goods and then adding some profit, then selling that product to the borrower. So this is arrangement is called Murabaha. So Murabaha is also one of, most of the Islamic microfinancial institutions, they are practicing this model, Murabaha, cost plus financing. Then they are also practicing Qarze Hasana. Qarze Hasana, normally the zakat money and waqf money is used for this purpose normally. But normal capital can also be used for this. Qarze Hasana means interest-free loan. Interest-free loan. So the amount of money, sometimes in Qarze Hasana also some fees can be charged. Fees. And that fees is very nominal. Nominal means normally the fees is not expressed in terms of interest or in terms of percentage. Some fixed fee is charged, and that fee is just to meet the cost of administering that Qarze Hasana, because at least one office has to be maintained, some person has to be employed to keep the record of all the borrowings and lending, some accountants have to be employed. So from where the payment for of their salary will be made out. So for that purpose, some fees can be charged on Qarze Hasana also, but that fees is very nominal, maybe 0.5% or, but again that will not compound, that will be fixed. Musharaka and Muzaraba, these are the two examples of equity based financing, and they are superior to the Murabaha. Murabaha is cost plus financing. Musharaka and Muzaraba are equity based, because the financer basically becomes partial owner of that business in both Musharaka and Muzaraba. Equity-based contracts protect the asset owner from the pressure of inflation. This is actually, the benefit of becoming owner in that business. That if the business owner is basically protected from the pressure of inflation, because of inflation, if the prices are going up, and as a business owner we own some goods and services, then the prices of those goods and assets will also increase. So, but as a consumer, we will not be protected from this pressure of inflation, because as a consumer, as a buyer, we have to face the harshness of the inflation. But as a business owner, normally we transfer the pressure of inflation to the customers. So this is one of the benefit of becoming equity owner. The second point, advantage of equity-based financing is sustainable form of financing for the economy. So equity-based financing is more sustainable. Sustainable means it has been found that debt-based transactions lead to instability in the financial system and lead to financial collapse that the world has seen a lot of times in a lot of countries. For example, recently in 2008, there was financial crisis, and that financial crisis was mainly the source of that financial transaction was extension of loan irresponsibly. A lot of loan was extended without much due diligence. So that was one of the reason of that financial crisis. I mean, millions of people become poor, millions of people became homeless, they became penniless. And their houses were sold, and I mean it led to a lot of harshness. But as far as equity based financing is concerned, this is more sustainable. I mean, it will not lead to such upheavals in the economic system. So this is another feature. In the case of Pumi and Croson, the experiment results show that borrowers using Muzaraba and Musharaka contracts are more likely to comply with their terms of loan than those under interest-based loan arrangements. This is one of the study that is being quoted here. Islamic Microfinance and Maqasid al-Sharia. Islamic Microfinance is also in line with the Maqasid al-Sharia. Al-Khan and Kabir Hassan in their paper in 2020 said that practice of Islamic microfinance serves key aspects of Maqasid al-Sharia, including based on Kyrgyzstan case study. Okay. Maqasid al-Sharia, you are already aware of this concept that Maqasid are the broad aims of Islam or broad aims of Sharia, broad aims in Quran and Hadith. What is the ultimate objective? So these objectives are derived out of Quran. So these are some of the objectives which are related with microfinance. So the first one is poverty alleviation. Of course, helping poor, giving, uplifting them, empowering them is one of the most noble act of humans. So poverty reduction is also one of the aim of Sharia. Then the second point is economy enhancement, that money should not be kept in without any use. Hoarding of money is despised in Quran and Hadith. So economic activity should increase in the market. So economy enhancement is going on because some people are being uplifted with the help of microfinance. So this is also related with this maqsad, that is economic enhancement, is also related with Islamic microfinance. Enhancing social condition of society. Social condition of society, one of the major reason is financial condition. Financial condition is very poor, and that leads to lower social condition also. So enhancing social condition because of Islamic microfinance, or the social condition of the people will also improve, and this is a desirable thing. Wealth distribution and circulation. The wealth should keep circulating. The wealth should be distributed among all sections of the society. Income inequality should be addressed. Income inequality, that money should keep circulating. It should not be restricted to the richest section of the society itself. It should come to the poorest also. This is also one of the objective of Islam. Then fifth point, on the basis of which we can say that Islamic microfinance is in line with Maqasid al-Sharia, is enhancing intellectual level of the society. Enhancing intellectual level of the society is also important. And one of the way through which intellectual level can be enhanced, the intellectual level of the public can be enhanced, is extending microfinance to the poorest section of the society, so that they may become more productive for the society and for themselves also. Islamic approach to poverty alleviation is zakat and sadaqah. Zakat is compulsory payment, sadaqah is optional payment, but it is encouraged. All Muslims are encouraged to make sadaqah. But as far as zakat is concerned, it is obligatory. It is obligation. I mean, if somebody is denying that, I mean, I should not, I will not pay zakat, I don't believe in zakat, then he cannot be termed as Muslim because it is one of the pillars of Islam. Out of 5 pillars of Islam, one pillar is zakat. So zakat and sadaqah as instruments of charity occupy a central position in the Islamic scheme of poverty alleviation. But if we talk about the reality, the real condition right now, uh, this zakat money is not channeled properly, and even if it is channeled, in some manner, then a lot of things can be done for this country. A lot of universities can be opened, a lot of good social upliftment programs can be conducted. I mean, it's a big money, and there are two problems. I mean, on one hand, a lot of people are not making payment. Then those who are making payment, that money is not going to the proper place where it was intended to be made, for the purpose of education, or for the purpose of health, or for the purpose of elevation of poverty. It can be anything, but in reality, this is not being practiced efficiently. So zakat and sadaqah, but in theory, zakat and sadaqah are instruments of charity, occupy a central position in Islamic scheme of poverty alleviation. Zakat has been variously described by scholars as a tool of redistribution of income, a tool of public finance, and of course as a mechanism of development and poverty alleviation. Rules of Sharia are fairly clear and elaborate in defining the nature of who are liable to pay zakat and who are beneficiaries of zakat. So there are 8 categories of people who are eligible for the zakat money. The first and foremost category of potential beneficiaries is the poor and the destitute. So poor people are the first beneficiary of this zakat money. Why zakat? I am mentioning this zakat because zakat and sadaqah both are related with the concept of Islamic microfinance institution, and zakats and sadaqah money can also be a source of capital and fund for microfinance institutions, Islamic microfinance institutions. A greater degree of flexibility exists with respect to the beneficiaries of sadaqah. But as far as sadaqah is concerned, it can be given for any good purpose, any social purpose, any good purpose. But as far as zakat is concerned, the beneficiaries are mentioned specifically in Quran, that you can give zakat to whom. But as far as sadaqah is concerned, sadaqah can be given for any good purpose under the sun. So this is a difference between sadaqah and zakat. Zakat is specific and sadaqah is general. And zakat is compulsory, sadaqah is optional. Sadaqah, people are encouraged to give sadaqah, but zakat, for every Muslim, payment of zakat is compulsory. 2.5% of wealth has to be paid mandatorily each year by Muslims who own a minimum amount of wealth known as nisab. There is nisab. Nisab is 87.48 gram of gold or 612.36 gram of silver or their equivalent value of money. So if somebody owns 87.48 gram of gold or equivalent money, or whatever is the currently the 10 gram gold is priced at around 39 or 38,000 maybe. So 38,000 multiplied by 8.7. So that will give us the figure in terms of Indian rupee. So zakat nisab is the minimum value is specified in terms of gold and silver. So if somebody owns this much gold or its equivalent amount of money in his bank account, or his wealth is more than that, In that case, he has to make payment of zakat. And if his wealth is less than this, then he is not able to, he is not liable to pay zakat. Hence, the monetary value of nisab varies according to the current prices of gold and silver. So the monetary value, or the value in terms of rupee, keeps changing because the nisab is defined in terms of gold. So as the prices of gold changes, the nisab also changes. This payment is made to purify a Muslim's wealth. So the purpose of paying zakat has been mentioned in Quran. Zakat itself means purification. So zakat means purification. So purification of money, purification of wealth. So everything has some objective. So the objective of zakat in Quran has been mentioned as purification of Muslims' wealth. These are the 8 categories which are eligible to receive zakat. Zakat can be paid to deserving individuals or groups who fall into one or more of 8 zakatable categories. These are zakatable categories designated in the Quran. The first one is poor. अरबी में कहते हैं उसको फुकरा, मीनिंग लो इनकम और इंडिगेंट. फुकरा मीन्स पुअर, जिनके पास पैसा नहीं है, दो इनकम ग्रुप, बहुत कम पैसा है, दे कैन नॉट मीट आउट देयर नीड्स एंड compulsory requirements. The second one is needy. Needy, masakin, meaning someone who is in difficulty. So sometimes somebody may not be, completely penniless, but because of some emergency, because of some health reason, because रास्ते में सफर कर रहे थे, किसी ने लूट लिया, or maybe any specific condition, the person may be in requirement. Those persons are called masakin, bechara, masakin. So the second category is needy. The first one is poor, then needy. There is difference between poor and needy. The difference is that the poor does not have any money, but the needy has some money, but that money is less than what he requires for whatever difficulty he is in. Then the third category is zakat administrator. So those persons who are, giving their service as far as zakat collection, zakat administration, zakat distribution is concerned, their salary may be paid out of the zakat money. The fourth category, those whose hearts are to be reconciled. The fourth category is to, the zakat money can also be given to any person to bring them to familiar, to bring the distance between different communities low. If there is difference between different communities, then that money can be used for communal harmony also. Then the fifth category is those in bondage, slaves and captives. So this point was relevant, thousands, when Islam came, slaves and the practice of slaves was there. So Islam encouraged to make slaves free. So zakat money can also be used to making slaves free. So we can, purchase slaves and make them free. So, but this point was relevant. Hundreds in that time, not right now, because the practice of slaves is not practiced right now. It has been, completely discontinued. Then the sixth category is the debt ridden. Somebody who has taken a lot of loan and he is not able to make payment. The zakat money can also be given to that person. The person who is under a lot of debt. Seventh category is in the cause of God, for any good cause. For the any good noble cause, the money can be given, zakat money, in the cause of God. Then the eighth category is the wayfarer, meaning those who are stranded or traveling with few resources. The primary issue with zakat and sadaqah dependent institution is the issue of sustainability. Sustainability is one major issue, because zakat and sadaqah cannot be, we cannot guarantee that this much of money will come from sadaqah source. So sustainability is one of the issue, as they are essentially rooted in voluntarism. Funds mobilized through charity could fluctuate from time to time and may not lend themselves to careful planning and implementation. The issue of sustainability addressed in the institution of Awqaf. In Awqaf model, Waqf model, the issue of sustainability is addressed through creation of permanent and income generating physical assets. So if through Waqf money, say for example, building can be constructed and that building can be lent out, um, and every month some rent money will be collected. So this is a Waqf model. So Waqf model, the issue of sustainability is not there because it is more sustainable as compared to the concept and model of zakat and sadaqah. Awqaf through creation of permanent and income generating physical assets. Awqaf has historically been the major vehicle for creating community assets. On the flip side, the restrictions on development and use of assets under Awqaf for pre-specified purpose introduce rigidity into the system. But the problem with Awqaf is that whenever a person makes some asset as Waqf, the objective has to be fixed. I mean, and that objective is very rigid and we cannot introduce flexibility in the system. Say, for example, if I am making some cash waqf means I'm giving some money for money, not asset, but money that can be called as cash waqf. So cash waqf for student scholarship. So that money will go to the students and then as Qarze Hasana, and once they will become when they will become able to make payment, they will make a payment. This is interest free, and once that money will come back, then the same money will be lent out to other students as Qarze Hasana. So that can be an example of cash waqf. So the purpose is very well specified that the money will go for the study students as interest-free loan. So the objective is very well specified in case of Awqaf. So while estimates of actual zakat collected in Muslim countries reveal that the quantum is grossly inadequate to meet the financing needs of the poor, the impact of zakat and sadaqah on poverty alleviation, once their full potential is realized, remains to be seen. If charity-based funds are inadequate, then recourse must be found in commercial approach. So there are two approaches of Islamic microfinance. One is charity-based approach, another is commercial approach. So if charity-based resources are not able to are not adequate for poverty alleviation, then commercial approach can also be it's allowed. We can do this microfinance, Islamic microfinance activity for commercial purpose also, for profit based institution. We can establish profit oriented institutions also instead of charity based. It's not that establishing profit oriented institution is not allowed. Profit based institution is allowed, but the focus should be on first we have to take the benefit of charity based funds. Then Islamic microfinance institutions should be able to mobilize resources either through accepting savings deposits or obtaining funds from local Islamic banks for onward financing or from the capital market. This commercial approach entails charging and sharing of profits and is quite consistent with Islamic Sharia. Okay, so have you seen your exam schedule has already come, and because of several reasons, the classes are very less. So what I will do is that one assignment has been given to you. Kindly do that assignment, submit that assignment, and maybe I'm thinking about some other component of the assessment also. So out of those two assessment, I will give marks out of 70. Then as far as the final exam is concerned, that will be for 30 marks. And out of that 30 marks, it will be, a Viva. So 30 marks Viva, and which will be on the date in the date sheet exam as per the exam schedule. So if there is any question, you can make.
So what is going to be the syllabus for the exam?
Since this is a 2 credit course, so there is only 3 units. So the syllabus is not very large. Syllabus is very small. So just keep it as it is. I will share these slides with you and some additional study material also. Just go through these slides and those study materials. The study material will be not very large. I mean, it is concise. It will be concise and compact.
Sir, have we completed all 3 units?
The third unit is for case studies. So for that, I have given you those papers. Those papers are actually case studies of different financial Islamic financial institutions. So that will cover that aspect. And the first and second, first one is for I mean, 2 units are covered in a very. Last date for assignment, second assignment. It may or may not be there, but I'm just thinking about that, how to do, this assignment. The one assignment is for 35 marks, and the second assignment, or maybe it may be Viva also, because I was not able to interact with all of you. So if I will conduct a Viva also, then that may also be useful. At least I will become familiar with you.
Sir, till 13th we have to submit assignments of other subjects too. So is it possible that if you will give the assignment, then we can submit them after the exams?
After the exams? No, just keep submit before the exam. That is the last date. I mean, on whatever date the Viva is there, just submit before that Viva. Otherwise, it will be too late.
Okay, sir.
No, I have just reduced your burden. Just study one of them and summarize and write the summary in your own words and submit. Okay, thank you very much for joining us.
Thank you, sir.
Thank you, sir.
Thank you, sir.